Hi, and welcome to the LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. And we're happy to have you with us today. The release of the Manufacturing PMI revealed a reading of 47.2% in September. That matched August's reading, and it's the sixth straight month of contraction and 22 out of the last 23. As we discussed on this broadcast last month, the severity is not the same, but in terms of length, this is one of the all-time historic contraction periods for the PMI. We should also note that the data was collected before two significant news events that will impact manufacturing and especially supply chains. Hurricane Helene, which of course has devastated the Southeast, and the dock workers strike that began at midnight, stopping work at ports on the U.S. East and Gulf coasts. And we'll talk about a lot as usual. So let's bring in Timothy R. Fiore. He is the chair of the ISM Manufacturing Business Survey Committee. Tim, another eventful month, as you know. Just what stood out most to you as you look at the September numbers?
Yeah, good summary, Dan. Thanks for the lead in. Right, our collection here did not include obviously the strike at the dock workers. Although we had a lot of comments about concern about that, and that hurricane just tore through about a week ago. And I remember back when I was early into this role, we had a hurricane come through. I think it was Gloria or something like
Harvey,
that.
I think, yeah, in 2017.
Yeah. And that took our supplier delivery number from a low 50s to like a 70 or 75 because it clogged everything up. Texas, it really impacted Texas. Texas is like 22% of U.S. manufacturing. So when you see something like that, it has a huge impact. So that could happen in October. Which, because my overall point here is that I don't see us coming out above 50 before January, but we could have an unusual event here in the October timeframe because of this hurricane that could throw that supplier delivery number way north, which could drag the entire PMI number with it. We'll see. The global strife, unbelievable what's happening this morning. We'll see where that goes, getting more and more nervous. All bets are off, if this thing really explodes. No pun intended, but it was a good lead in, Dan. So let's talk about the month. We came in flat to the last month, which really says we're declining at the same rate. The PMI is not equal to last month, meaning this month is the same as last month. The PMI is saying that we're still declining at the same rate that we saw in the month of August. Okay. I look at this thing from demand, output, and inputs. Demand is still non-existent, although we had some really good signs a couple of weeks ago with Chairman Powell cutting a half a point and indicating there's probably another half a point to come. And I think those are both good statements. That took a lot of pressure off of business leaders in terms of where are we headed, what should we do, what should we forecast for 2025? When is the Fed going to make a move? Higher for longer went on, longer for higher, or higher for longer. It went on for a long time, and that really ended up not killing, but not helping 24 be a growth year. 24, as we've said for many months now, is a liquidity year. And now what the Fed is saying that, okay, we're going to take some of this restriction away. We're not going to be accommodative. We're not going to be neutral, but we'll take some of the restriction away. And before the end of the year, we'll probably see another half point come out. That's all good. We'll still be restrictive as we join January. And then the other issue that we talked about the last couple of months is the election period now. We're into the election period. Although neither one are talking about deficit reduction, their investment plans are significantly different, and their tax policies are significantly different, which will have an impact on a lot of stuff. So I don't see us really clearing on the demand side until January, when the election is well understood. The House and the Senate will know if it's a triple header or whether it's a divided legislature or not. We'll see. Those all have major impacts. But we're not that far from January. That's fine. I don't see us going above 50 before the end of the year, as I mentioned, except for maybe if that hurricane drives our supplier delivery number up. So demand, I'm expecting demand to start to come back, to show up in January. We are seeing a little bit of an improvement in the month of September on demand. We're not contracting as fast. There's a seasonal factor in there that had a little bit of an impact, but I think the trend is we're slowing down in the contraction of demand, which is good. We also saw a little bit of an improvement on the backlog number. Not much, but a little bit. We're still strongly contracting. We need that backlog number to get back closer to 50 so we can build back an order book. Nobody's going to stick out their neck with significant investment decisions when the order book is near zero and new orders aren't coming in. So we need to see those two come back. And the last thing on demand here is really the new export orders contracted faster again. Our international trading partners are not helping. And in the near term, I don't see any help coming, although there's a bunch of stimulus happening in China that could have a carryover effect into the U.S., probably in the October, November timeframe. So, all right, things are underway with demand. We'll see how it works out. Not much that we can do at this point.
Yeah.
Go ahead. You want to talk about demand?
Oh, no, we did just focus on the breaking news and get that discussed. I mean, you fielded a lot of questions specifically about the dock worker strike and the impact that could have on employment. I know you alluded that you kind of expect a quicker resolution to it, but I mean, if worst case scenario, if it does drag out, just talk about some of the potential ramifications if that is an onerous, lengthy delay. Yeah.
So based on my experience, more often than not, there's a strike when the longshoremen negotiate a contract with the carriers. This is affecting containers, TEUs. It's not affecting bulk. It's not affecting bulk. So that's a good thing too. And so we're talking about the transport of goods primarily in containers. A week strike, no big deal. We had a bit of an alarm on the West Coast a ways back, although they were operating without a contract for some time. One of the problems here, this is almost like a tutorial to some extent. It appears that they strike 6-year contracts. So 6 years ago, somebody had to predict what labor costs would inflate, cost of living would inflate, and that was all baked into the contract 6 years ago. Well, you know the way forecasting goes. The longer you forecast out, the weaker the probability of it being accurate is. And so when you're hearing the dock workers, only 50,000 or so of them, 50,000, that's it. When you hear them looking for a 60 or 70% pay raise for the next 6 years, you can kind of put it in the context of 6 years ago, they probably forecasted a 2% cost growth. And that's not what we saw in the last 4 years. We saw what, 25, 30%? So this whole thing is they're trying to catch up. Now, the carriers are coming out of a period a year and a half ago where they made a lot of profits. The last year and a half, they have not. But okay, so are they in a position to be able to accommodate the longshoremen? I would argue that, yeah, they probably are. If they're not, they're really micro-focused. And to have 50,000 people disrupt the entire U.S. economy is just not realistic. Unfortunately, the current government is a pro-labor government, and hopefully they'll intervene when they need to intervene without this thing going more than a week. You get this thing going a month, you're talking about a 3-month fix. What this is going to happen, what's going to happen here, if it all happens in a week, no big deal. If it goes beyond a week, we're going to be disrupting transportation chains. It's going to cause a huge amount of confusion in road freight. And usually road freight is a good indicator of economic activity coming back. But if it does that because of a strike, it's a false comeback. And then it's going to really confuse things in the grow out. So I'm just hopeful that common heads prevail here and that, the longshoremen and the carriers come to an agreement. Maybe one of those agreements is don't have a 6-year long contract.
Yeah.
That would be right. Anytime that these kind of things happen, you kind of feel good when you've moved the risk to the longshoremen, but now you got to kind of pay the price. So you have to look at it in this whole context.
Yeah.
So I'm hoping the thing gets resolved within a week. There won't be, if it goes longer than a week, we're going to have some amount of disruption. October is already going to be a disruptive month because of the hurricane that came through, as you mentioned, Dan, and we talked briefly about. That's going to have a significant impact. I'm not sure if I mentioned it yet this morning. Texas is about 20% of U.S. manufacturing, and this impacted Texas because you had to pretty much shut down those wells in the Gulf because you didn't know where that hurricane was going. So you had to shut them down. You're restarting them now. Fine. You see the price of oil kind of going up, but it's not going up dramatically. The bigger issue will be plastics factories. We're already seeing price growth on plastics still. from a couple of months ago, and when we had an impact into the Gulf a couple of months ago. This one could be bigger. And on top of that, you've got that huge piece of North Carolina, Tennessee, especially. Tennessee is a big manufacturing state. You got floods, you got transportation routes disrupted, you got people not able to go to work. October is not going to be a very good month for accuracy, I think, in terms of where is the economy headed. It'll be accurate about what's happening in October, but it's not going to be a really good data point for January, February, March.
Yeah. Well, yeah, let's talk about demand. I mean, it's obviously the linchpin in our, in our equation, what we talk about every month, but you put it in a context earlier in an interview that you did, I thought was really interesting in terms of what companies and factories are doing to prepare for when demand returns, especially in related to employment and inventories. We'll talk about employment first. That index further contracted down to 43.9% compared to 46 the previous month. And the phrase you used in an earlier interview was cleaning up. Discuss that continuing right sizing, and it seems companies are trying to do what they can to prepare themselves, put themselves in the best position when demand does pick up again. Just discuss that dynamic.
Okay, so order books have been depleted pretty much. 24, 25 months of backlog contraction. I mean, it was the greatest period of over ordering in my lifetime. And it's taken 2 years to kind of clear it up. So you can easily make the argument that the order books are empty, and we don't have new demand coming in. So, okay, what's going to cause this thing to kind of free up? You got to have a feeling of, is the economy growing or not? And right now we're not. The Fed is signaling that, okay, I'm getting ready to make it easier to grow, but I'm not going to be supportive yet. I'm still restrictive. So what happens in the meantime? Well, you kind of read the tea leaves. Are you going to make that investment in the capital equipment? You kind of feel that, well, I know sometime in 2025, it's going to be better. Probably the first half will be better than the second half of 2024. Should I go ahead and make that commitment? I got the cost of money coming down, and it will probably continue to come down as we enter 2025. So those are all positive. The issue, though, is that you don't want to make a commitment unless you have some idea on your forward forecast. And we still don't really have that idea. We haven't had a pure supply demand capitalist market since 2019. So are we going to get back to that? I hope so. So let's talk about the output. The point I made was we're continuing to destaff labor headcount. We're destaffing at a 1 to 1.5 based on the comments. So for every 2.5 I'm getting, 1.5 of those 2.5 are reducing headcount. And the tool they're using, 60%, which is very similar to last month's 66%, is layoffs. So the other pieces are freezes and attrition. And when you have time, you use freezes and you use attrition to get your head count down. When you're running out of time, you use layoffs, because with the layoffs, you got to pay a severance. Freezes and attrition, you don't. So when you resort to layoffs, it's really saying it's more urgent. So what's happened here is we've resized our factory output to meet what we expect to be the current demand levels. And most likely it's a conservative demand level, not an optimistic. We've had plenty of optimism over the last couple of years. At this point, it's probably like, let's go to the conservative side of this because I'm tired of being burnt. We had the month of September, essentially the same output in September as August. August, we stepped it down. And I think in July, we stepped it down too. Yes, we did. So this is all good. What it's saying is we have a stable output. We still have enough order book to be able to do a stable output, but our cost structure is still too high to manage that level of output with our future demands of revenue. So we have to continue to take headcount down, which is the overlapping carryover effect. So the month of September saw us continue to take headcount down, even though our production headcount was stable. I think those are good things. It means companies are managing their inputs and outputs. I expect to see that employment level continue to contract at this kind of level. But obviously, if we don't get more new orders, eventually you're going to see headcount come down even more. I mean, they're planning on a level of order activity that hasn't shown up yet. But in the meantime, they're taking headcount down to match that. So I think that's kind of where that all is. we'll see if it's a half a point cut additional through the rest of the year, or it's more than that. We'll see. But I think the biggest issue right now is the election cycle. No deficit reduction talked about on either side, but tax increases on one, tax decreases on the other. Extension of the tax increases for the under 400,000. That I think is going to happen no matter which administration gets in. And then you have the investment profile in conventional energy or in new energy. I mean, the investment profiles for each of the parties is totally different. So, the good thing is we're 2 reporting periods away from clarity. That's not bad. And we're going to enter a new economic period, 2025 calendar year, very soon with quite a bit of clarity. So it's almost like what is going to be unclear? Well, the unclear thing is the international strife, the Ukraine war, the Middle Eastern war, the conflict with China. Those are going to take on more of a predominant place. I think this whole tariff thing on the Republican side, I think it's really talking. Although, the candidate on the Republican side has had a history of executing what he has said that he's going to do and what he does. I do not see tariffing all imported goods as a good thing. I do not see that.
Yeah. Another dynamic, obviously we've talked about it in recent months that is, impacting or that monetary policy and demand levels have an impact on is inventories. That index has been interesting the last couple of months. Spiked up to expansion last month, 50.3%, and now back down to 43.9% in September. You had mentioned timing issues and trying to sync up with demand. I know I've talked to you a lot about it, the challenges that is just in normal times. Just discuss the ride that index has been on in the last couple of months.
Yeah, so we've had an extended period of contracting inventory month to month. Really, we're talking about manufacturing inventory. Our inventory number, ignore the customer inventory number for now. And then last month we saw it break 50, which meant that it was stable month to month, although our output dropped. So the turns got worse. And that's nothing you ever want to see, especially without a reason. In this case, the reason is they stepped down production, but they probably couldn't stop the amount of inbound material coming in fast enough. So maybe they stepped production down at the second half of the month. So, the analysis that we had last month was this is a one-time effect. I think it's a timing issue. In the month of September, it'll get back to where it was, and that's exactly what happened. So on the input side, I think we're in great shape. Suppliers are still holding more of our manufactured inventory than traditional companies. Our panelist companies are still unwilling to take additional input material. They don't want to finance it. It's a liquidity year, remember. So they're pushing it off on the suppliers, let the suppliers hold it. And the supplier stiffness at 52 is a good number. 48 to 52, 53 are all good numbers. It means that you're almost kind of neutral. There's no exact number that's neutral. 50 is not neutral. There's kind of like a range. So 48 to 53 is about neutral. It's an appropriate amount of tension, not too fast, not too slow. So I feel good about the supplier delivery number right now. I feel good about the inventory number. It means that our panelist companies are not overstocked and stuff they can't convert. So it kind of says that the supply chain is working properly. I think that's what it's saying. It's working. It's in sync as well as it can be, given that variables change month to month. It's not negative. It's not positive. It's good. Yeah.
You mentioned the customers inventories index briefly. I know that's an index that we get a lot of questions about at ISM from time to time. With this month's status kind of new, we call it about right. Just to explain what that means.
So our panelists report to us how much of their inventory they think their customers have of their stuff. And about right says that, okay, customer wanted 10, I got them 10. They have about what they wanted. Okay, that's good. It's good from a supply chain standpoint. It's not good for a future demand standpoint because you really want your customer to not have enough of your stuff because this means that you can ship more of it the following month. So, but as far as the customer inventory and the entire supply chain is concerned, this is good. It's about right. It's neutral to negative for future for next month. which isn't a bad. It's a weak negative, not a bad thing. It's one of those elements I use for future demand. And this month, it's about right. It's neutral to negative for the future.
Yeah. Well, one of the bright spots this month, and you mentioned it earlier, was the production index. And I know I've talked to you over the course of our calls here or our monthly broadcast here. That is an index that has been really resilient during this contraction period overall for the PMI. There were a lot of months where the reading was a little bit higher than you would expect, given some of the other dynamics. And this month it bumped up to near expansion, 49.8%, up from 44.8. Just what were some of the factors that were at play for that this month?
Yeah, so I like this. This one has been extremely important in the recovery period because it does reflect what's happening today. The new order number is what's going to happen most likely in the future. The production number is showing you what's happening today, and it's really a great surrogate for revenue, especially if you're not building inventory. And our inventory number here is a combination of raw materials, semi-finished goods, and finished goods. And obviously with it contracting at a 44, we're not building inventory. So the production number is a good surrogate for revenue. Back in May, we saw that production number kind of come off. And that was like the first warning that, okay, we got a problem happening here. And then we saw production kind of stabilize June, 48.5 into June. And then in July, we saw another step off, which looking back, that was a reassessment. And I think we reported it at the time. That was companies saying, hey, my forecast is overstated. I need to take it down. And then when we took it down, we saw the employment number come down too, meaning that they were starting to eliminate more and more people. So we're almost following a stair step thing here, which is really good because, all right, we're making the adjustments. We step it down. We run 2 or 3 months and we see where we are. And we either step it up or we step it down. And I think what you're seeing here is we saw a step down from June to July. July and August were step downs in production, i.e. revenue. We had to resize our output, consistent with demand. As a result of that resizing, we had excess headcount, and we started to take the headcount down to in the same time period. In July and August, we took headcount down too. We're continuing to take the headcount down in September, even though production is up, which kind of says that we didn't take all the headcount out that we wanted in the July-August timeframe. I don't expect that number to continue to stay at a major contraction. I think we're taking stair steps, and my guess is outside of the hurricane impacts in October, is that without that happening, you'd see that employment number go back into the high 40s again in the October timeframe. But I'm not sure what the hurricane's going to do. There could be a lot of furloughing going on. The strike could do the same thing. The employment number will be impacted by that. I don't think October's employment number is going to be a pure supply demand net number in October because of the hurricane and because of the dock strike, unfortunately.
Yeah. I would imagine another index that would be impacted by a lot of the factors that you just discussed and we've been discussing would be prices. Kind of a mild surprise. It went back into decreasing territory at 48.3%, down from 54. And you had mentioned, that there was a lot less volatilities on some commodities like metals. But, given, some of the breaking news that we've discussed throughout this broadcast, do you think that might be a little short-lived, that you would expect that index to maybe tick back up again?
Well, yeah. So last thing on production is what we haven't talked about is the Boeing strike. The Boeing strike. 35% of our transportation equipment sector, which is about 14% of total manufacturing GDP, is aerospace. And right now our transportation equipment sector is contracting strongly. It's in the 43 range. A couple of months building up to that. Automotive is a primary contributor of that, and the fact that people can't afford new cars either because the interest rates are too high or the price tag on the car is too high. We have action on the price tag of the cars starting to come down. A lot of it driven by commodity markets, which are helping the automotive guys. And we have the interest rates coming down too. They're not at the zero level, obviously. They probably never will be again, but we need them back down in the 3 to 4% for a car loan. And then you'll see demand kind of come back. If the aerospace guys start to shut down because of Boeing's shutdown, Boeing traditionally allows their suppliers to continue to ship, especially when they're trying to get up to a 40 or 50 737 output rate. and they're only sitting at 27 or 30. They're going to allow them to continue to build and ship until the liquidity gets so bad that they can't. And Boeing today announced that they're actually looking at releasing more stock. Not a good thing. So that's a huge headwind for transportation equipment if Boeing doesn't get this strike over with and start shipping airplanes. So huge headwind on transportation equipment. Okay, let's get the prices. I think a 48 to 52, 53 month to month is a fine range. It shows a volatility. We got commodity markets are constantly changing. We have semi-finished product that has more commodity in it than labor, and then we have products that have more labor than commodities, and those are all changing at different rates. 48 to 52, 53. I'm not worried about that. It's contractions bigger than that. 45. I don't see that happening. There's no reason for that. And then on the other hand, you got price growth well above that. Now we might see some, plastics markets see that kind of volatility. You might see natural gas. We're already getting into the high to mid twos on natural gas, which will have an impact. But those will all straighten out over time when you take these external factors out. I don't see price growth right now as a major issue for manufacturing. None of the commodities are leading to it. Oil, what happens in the Middle East could have a huge impact on the oil price. That'll ripple into everything. But right now, as we sit here today, I don't really see a major price impact shock coming.
Yeah. It's one of those months where I wish we had more time. I got my list of questions here. I won't get all through them because, we discussed so much today about the things that we did talk about. So about a minute left here. Anything that we haven't discussed or anything that I haven't asked that you think might be vital to what viewers should know about the data?
So, I think the summary is demand is still non-existent, but there is hope that interest rates will re-spur demand. There's hope that the fiscal activity will get resolved in the next 6 weeks, and we'll know whether it's a united Congress or a split Congress and whose policies will prevail and where we're going. So by the time we get to the November report and on December 1st, it's going to be an interesting analysis. Revenue is still holding up. So there's enough order book to maintain a stable amount of output, which is good. Again, we're still destaffing people to maintain profitability. Again, good. Suppliers are stiffening up a little bit at 52. That's good. Manufacturing inventory in the low 40s. That's okay. I like to see it higher, but I want to see it higher for the right reason. I don't want to see it higher for the wrong reason, so I think that's good. So we're here. I think demand will come back in the first quarter of next year. But in the meantime, I think we're going to be hanging below 50 as we close the year.
Yeah. Well, we'll look forward to next month when our waiting game on demand will continue. But thanks for joining us today. And for more information, feel free to go to ismworld.org, where in a little bit you can read our roundup article that details a lot of what we've discussed here. And right now you can read an article on the potential impacts of the dock workers strike. Our colleague Sue did a great job on that, and that's up on our website right now. Join us on Thursday when we discuss the Services PMI with Steve Miller. He's the chair of the ISM Services Business Survey panel. Whether you would like to be a part of the ISM Manufacturing Services or Hospital Business Survey panel that help compile data for the monthly report on business, you can visit ismworld.org/join the panel for more information. And so for Tim Fiore and some people who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name's Dan Zeiger. We'll see you next month.